I'm really excited today. We're going to be having a conversation, the first, hopefully at least two, maybe three or four, talking about the future of Treasury cash liquidity risk management. The catalyst for this clearly has been the renewed focus on this, or maybe not even renewed, the focus on this, certainly in the startup community, but more broadly across the economy since the SVB liquidation a few weeks ago. We're not going to talk. I suggest we're not going to talk a lot about that and its proximate causes and outcomes. That's something that I think is being amply. That's a space that's being amply filled already. And quite frankly and candidly, I think if there's something for us to add that or intelligently add to that conversation, it probably would behoove us to wait a few months or maybe even a few quarters to really be able to do a more thoughtful retro. Not to say that a lot of the information that's come out is not thoughtful, but it's, again, I don't think we can add a lot to it. The proximate causes were relatively straightforward, but I think there's a lot of interesting things around it that are new, and many of those have been brought forward and discussed by other players in the market. So here, what we really want to talk about is the consequences, the direct consequences in the sort of, especially in the venture ecosystem or the startup ecosystem of that, given Silicon Valley Bank's prominent position as a banking provider in that community, focus on liquidity, cash, treasury risk management, which is something that historically has not at all been a focus. And I can say that with an enormous amount of confidence, because this is something, I want to state absolutely candidly that I did not expect or predict or call the demise of SVB or any other, significant bank to the startup ecosystem. But having been a capital markets and a fixed income person for all of my career until starting Anthemis, it's something that I was naturally attuned to be sensitive to, found in this sort of new community that I was now a part of over the last decade or so, somewhat frustrating the lack of acknowledgement even that this was something that should be looked at. And interestingly enough, especially because in the first instance, using the 80-20 rule, I believe a lot of the potential extreme risks that emerged in the wake of the SVB bank run were completely avoidable for most of their customers. And so I'm really pleased to first, we're going to have two conversations in sequence. First with Kevin, who's one of the co-founders and CEO of TreasurySpring, one of our portfolio companies, and then with Jess Holzbach, who is the CEO and founder of Pile, another one of our portfolio companies out of our Female Innovators Lab, talking from, I think you'll find interestingly, from quite different perspectives in terms of the issues and the opportunities arising for helping not only startups, but companies in general, especially smaller or mid-sized companies who don't have giant treasury teams or finance teams to manage their liquidity and cash and treasury risks. So with that introduction, I'd like to jump in and ask Kevin if you could introduce yourself. I think and most founders know when we first meet, I'm always interested in origin stories because I think they are founders, because it frames not only why they might be or that team might be the right team to address or solve a problem, but also gives insight as to how they even see that problem set. And that sounds, again, perhaps obvious, but I think it can be, as an investor, it's always very, very interesting. So I think for our audience, perhaps if you could give us maybe a 5-minute, how did you get to the point of needing to create TreasurySpring? What was the problem that you saw that you felt needs solved, and what was unique, or maybe not unique, but what in your background gave you the tools to A, identify that problem, and B, feel confident that you were in a good position to try to solve it?
Sean, hey everybody, nice to talk to you. So as Sean mentions, I'm Kevin, I'm one of the founders and CEO of TreasurySpring, which is a London-based financial technology company in the cash management space that I founded together with two long-term business partners back in 2016. Our story goes way back beyond that. So I was a lawyer originally, and then I met my two co-founders back in 2006. Working in fixed income portfolios at a hedge fund. And we were sat in a maturity transformed fixed income hedge fund through 2008, which left us with some pretty painful scars, but fortunately some fairly telling lessons. So what did we learn back then, I guess? Firstly, we learned that credit was a real thing. Secondly, we learned that contagion was a real thing. Thirdly, we learned that some of the transmission mechanisms in the capital markets were really quite highly correlated and suffered from a lot of the same maturity transformation issues that we experienced sat in a fixed income hedge fund. I think we also spent some time coming out of that as we founded our first business, looking across what the different options were for cash investment. Be totally candid, back in 2007, 2008, we didn't pay a whole lot of attention to it. We had a load of money that was left in a brokerage account at Lehman. I found myself at the doors of 25 Bank Street on the 15th of September 2008, trying to get back a load of money that we thought had been segregated as client money and turned out not to be so. That was pretty common across the industry. But when we founded our first business back in 2010, cash management wasn't meant to be the focus. It wasn't something that we were planning on, majoring in, if you like, until a conversation in the middle of 2010 sort of changed the direction of our careers. So we were talking to the manager of what was then a $35 billion hedge fund about what was on their mind, and they were talking to us about the fact that their biggest problem was there was something $10 billion worth of excess liquidity. And they'd used to leave that overnight at their prime or invest it in short-dated US T-bills. They'd used to not worry about bank credit risk. They happily earned 5% and charged 20% performance fees. And all had been good. They were also smart enough to realize that the world had changed from a credit, from a interest rate, and from a regulatory perspective. But that nothing had changed in terms of their strategy. And so they initially hired us for 3 months to look at what you could do with excess cash and the best ways to maturity match a big, massive liquid and illiquid portfolio, to look at how they could firstly minimize risk, key criteria. Secondly, match liabilities. And thirdly, and only when those first two things were solved, to look at increasing return and diversifying out some of the portfolio. So that 3-month engagement turned into an 18-month build-out of a load of technology, infrastructure, portfolio risk management, and other tools for the hedge fund. And on the side, we built a little financial business advising other folks like hedge funds on what you should do with excess cash. I guess the nice thing about the hedge fund community is they have lots of resources. They're very well connected to financial markets. They have lots of expertise. And so advice works because you can suggest things to do and they can implement it. But as we worked through that period, we started to wonder what it was like for everybody else, what it was like for all the people who were in the non-financial sector. And what we realized was that almost nobody, and this goes all the way up to the top of the FTSE 100, the US is slightly different, slightly more sophisticated, but certainly the UK and to a large extent in Europe, what we found was that even the largest of companies basically invested all of their cash either in bank deposits or in money market funds. That leaves you with big, unsecured, highly correlated risk to the banking sector in either case. And it was wildly different to what the hedge funds did, to what we realized by this point the bank treasuries did, where they took very little unsecured bank risk. They either invested in governments or supranationals or agencies. If they lent to banks, they did it secured through the repo market. And then they diversify out into corporate. They look at taking advantage of things like currency basis. So we were left sort of looking at those two different things and saying, how do we help everybody else to invest cash in the way that we kind of learned over the last few years is the best way? Long story short, we sold the advisory business to an asset manager because we realized that advice was useless to almost all of the non-financial market because they couldn't take any of it. They didn't have any of the infrastructure, the connectivity, the resources. And we went one step further at the asset manager, offering managed accounts to people. So saying, not only can we tell you what to do, but we can also implement it for you. And we had some success with that, but if maybe advisory had given us the ability to access 10 basis points of the addressable market, managed accounts maybe took us to 50 basis points. But it was still huge, huge swathes of what was a multi-trillion-dollar market that we weren't capturing. So we understood the problem really well. We understood the clients pretty well, but what we didn't understand was the transmission mechanism to get the money from where it was into the assets that we knew were the best assets. And I guess that was what led to us founding TreasurySpring back in 2016 to really try and solve that problem, to build new piping to enable money to get from highly correlated unsecured bank exposure into what we perceive to be the best risk-adjusted cash investments that are available in the market.
Yeah, and that's somewhere along that time is where we had the good fortune to meet Kevin and his team, and sort of instantly saw that there was an opportunity here that is vast. And again, for some of you on the call, you may know this, but many others may not. For the first 20 years of my career, I worked in capital markets, mainly in interest rates and credit. And for a big part of that as a trader in short-term interest rates, government interest rates and swaps and repos and what have you. And looking back on that, it was completely serendipitous. I didn't grow up wishing that that's what I wanted to do. But you start to understand the plumbing of the financial system, and you understand deeply how important that is, and basis points matter, and the playoff between liquidity and interest rate risk and credit risk in a way that I don't think anywhere else in the world sees. And actually, it's one of those things that when it's working well, you shouldn't see it. It should be invisible. It should be sort of like an electricity system. You only really notice it when the lights go out, when something's broken. And 99% of the time, or 99.9% of the time, the lights are on and everything's fine. But if you're in the middle of that, if you're the person responsible in the group of people and institutions and companies and whatever, you're responsible for making sure that 99.99% you're acutely sensitive to those risks that you were talking about, Kevin. And so when I transposed myself into the venture world, and especially perhaps not right at the beginning, and this was all post 2008, and there's probably just a heightened risk sensitivity in the beginning generally, but by the mid-teens and certainly the early 20s, just before COVID and then double down post-COVID, the risk appetite had gone way up. Interest rates were by then at zero. And so any dialogue that I had, and venture-backed companies, including some of ours, though we skew a little bit earlier stage, but some of our earlier stage companies had become later stage companies, were raising significant amounts of capital. And we found ourselves at Anthemis, voices around board tables that were quite alone in saying, what are we doing with we have $100 million in cash, and we're going to have that for a while, or it's going down 10 million a quarter, or whatever the burn rate is, but there's a significant amount of cash and it's just sitting on one bank account oftentimes. And a lot of the pushback, because the focus was, I'm going to pick this up with Jess later too, a lot of the focus was, well, Sean, interest rates are 0% or a bit more or less, and we don't want our CFO or a CEO or anybody in the management team running around trying to scratch a few more basis points out. That's irrelevant to the success or failure of the business, which was something I completely endorsed and was difficult to articulate. Was I didn't so much care about the basis points. Actually, probably the opposite. There's a few businesses that we've always been very cautious in investing in, what we call rate shopping businesses, because of our experiences in the noughties and right up to 2008, the Icelandic banking crisis. That when you're rate shopping or when you're splitting cash to chase yield, that actually can be the most dangerous thing in the world, because you're only going to get incremental. The incremental gain that you might get, the nickels in front of steamrollers, is irrelevant in the context of what capital protection, which is what liquidity is really about. And so I'll maybe wrap up and hand it over to you on that note. That yesterday, an old friend of mine, a guy called David Freeberg, who's the founder of Weatherbill, who's Climate Corps, was one of the first companies we invested in, tweeted, "Cash is now a risk asset. Wow, what a change of paradigm." And the irony was, I got the sentiment, but the irony for me was cash has always been a risk asset, and one of the most important ones. And again, if you're sitting on a treasury desk or a trading desk in an investment bank or at a Fortune 500 company, like especially the big cash-rich ones like Apple or BP, like this is absolutely a risk asset. But everybody else, actually, the new paradigm is now everybody knows it. That would be my. It's not that it's now a risk asset. Now everyone knows it, and so it's super early days. But do you sense? Am I just being wishful thinking, or do you sense that sort of new paradigm is possible, and that there is now a no going back type moment, that this will be just another, in a good sense, box to tick, that okay, this is a risk that we need to address. Here's our toolbox for addressing it. We need to address it, or will, when this all settles down and whenever that is, people will forget about it again, or?
Yeah, good question. I mean, I know what I'd like the answer to be. Whether it will be is probably a slightly different matter. I mean, we talked about this a bit over the years, but in my experience, everything in financial markets is driven by some combination of fear and greed. And what we saw, I guess, from the middle of last year was greed starting to take hold when it came to cash, and people were like, hey, actually, there's some money to be made here, and I can really start doing something. And you found scale-ups, startups for whom the revenue line item from cash suddenly started to become material. You know, we have a function in our platform that tells people what income they've made on the holdings they have through our platform over the last 30 days. And we had a couple of clients phone us up and say, I think there's something wrong with your calculation methodology, because they couldn't quite compute. Suddenly the numbers were this big. And then obviously SVB happens, Credit Suisse happens, and fear takes hold again. And right now, that's very definitely the prevalent sentiment across the market. Everybody is, as you say, doing what they should have been doing for a long time, which is understanding sort of the classic corporate treasury mantra, which is security, then liquidity, then yield, in that order. I think for a while, people were just totally ambivalent. Didn't even think about any of those three things. And then they started to think about yield. And only now they're starting to get their heads around the security and liquidity portion of it. I think there's definitely a market shift. I'd like to think that the shift is permanent. The venture industry, I think, was a little behind the times. Again, you and I talked about this in the early days, but it's not just, as a venture investor, it's not just a case of having, I've got this portfolio company, it's got 100 million, that 100 million to SVB. If you have, I don't know how many portfolio companies there are in the Anthemis portfolio, 100, 110, 120, something like that. If they've all got an account with SVB and they've all got the majority of their liquidity there, then all of your business is at risk from SVB. And all of your investors' capital, which ultimately flows through to the pension funds and the endowments, the insurance companies and what have you, is at risk because of a single point of failure. Like, that's nuts, and is something that should never have been allowed to happen, frankly. But SVB was a good bank, did good things, and did a wonderful job of convincing everybody that it was absolutely the right way to do it. And this is not that there was anything bad per se about SVB. For me, the blame really lies with the industry as a whole for allowing it to get to such a concentrated position, to the point where a whole industry could nearly have been brought down in the course of a weekend. So I hope that there's a permanent shift. I hope that people learn their lesson this time. Unfortunately, people in financial markets tend to have relatively short memories. And so I think it's incumbent on us as an industry to try to use the point at which this stuff is top of mind to really try and make some lasting change.
So I like that you reminded the audience of the sort of the three cardinal rules of cash treasury management. And, it seems to me that the knee-jerk response, it's not necessarily bad, especially if it's then, when there is more time, more thoughtfully thought about. Some of the things I've read, I don't know if this has evolved in the last week or so, but it was approximately 50% of the deposits that fled SVB ended up at Chase or JP Morgan. And then there's a sort of a hierarchy and T-bills and a variety of different things, but literally the lion's share ended up there. with the thinking that it ticks the security and liquidity box. There's nothing more liquid in theory if they're money good than call deposits. And security, JP Morgan Chase is too big to fail. Good for them. I also read something yesterday. I didn't fact check this, but apparently that they're now making approximately $750 million a day in interest from their accounts at the Fed, with the excess cash just being parked at the Fed. Good for them. But so the question to you is, how is a fixed term fund or a treasury string type product, but fixed term funds are something you guys I think invented, but it's like ETFs, isn't a how is that? How does that compare, let's say, in the toolbox of liquidity management options to a sight deposit with JP Morgan Chase on maybe on all three, but certainly on the security liquidity boxes?
Yeah, so I mean, maybe firstly, I think it's true that what people do the easiest thing first, and in large cases, that's take a flight to the safest bank that they can think of. And the too big to fail is a thing, right? Whether the Fed likes it or not, it really is. In the case of Chase, that's probably true. I would say this: Chase doesn't want all of these clients either, and they're not all going to get onboarded. Like the barrier to entry for getting a proper Chase banking service is, and certainly any of the big major global investment banks, they don't just open up accounts for everybody. So even if we thought that was the right solution, it's not quite as simple. It's great, just get probably on there. For us, as I mentioned, the challenge was, what's the transmission mechanism? We knew that people should get into government assets. We knew that people should get into supranational and sub-sovereign assets. We knew that people should get into the repo market because it's collateralized. And I was at a repo market conference yesterday, and it was fascinating. One of the guy who runs LCH, the London Clearinghouse, Bruce Calloway, stood up, and one of the points he put up on his slide was the question about whether or not to collateralize was answered a long time ago. The question is just now how to collateralize. And this is obviously an interbank wholesale market. And the thing is, in the wholesale markets, people realized after Lehman, if not before, that this unsecured lending business was a bit crazy. And they're dealing in, tens of billions of dollars. And that all of those trades basically are collateralized, and a lot of them are centrally cleared these days in order to kind of mitigate risk further. And yet you contrast that with the rest of us who all invest in these fluffy things called deposits, which is just an unsecured loan, right? And so everybody's like, oh, it's great, I got my money in Chase. Everybody in Chase is going, are you nuts? Like, why would I put my money just with another bank on an unsecured basis? Like, I'm doing this secured. And so I guess for us, it was, what's the transmission mechanism to enable people to get from unsecured to government, or unsecured to secured in the repo market, or even unsecured to diversify by accessing corporate. And so we came up with this idea for a single asset maturity matched fund, effectively, which is this thing that we call an FTF, or fixed term fund these days, which basically is totally segregated pass-through access to any underlying piece of fixed income. So it could be a 1 week US government fixed term fund. It could be a 1 month secured fixed term fund to Goldman Sachs. It could be a 3 month secured funds to Barclays. You get the idea. And so for us, we're not all of a toolkit for a company, but you need a checking account, you need operating accounts, you need the ability to manage cash flow on a daily basis. We very deliberately operate only in a term world. Now, that term can be as short as 3 days or as long as 13 months. We was very clear to people, if you match your assets and your liabilities, you can take that week term, or you can take that month term, and crucially, you don't have to worry about what else is going on in the rest of the market. Like, if people are running for the hills and trying to get your money out first, in this case, there's no liquidity risk, there's no mismatch. So as long as the counterparty pays back or your assets are good, you're going to get your money back. So for us, the strapline of the platform is minimize risk, maximize returns, and it's very clearly in that order. The first thing is, get to a point that you've absolutely got your risk in a box that you're comfortable with. And that risk isn't just credit, it's also liquidity and operational. And then once you've done that, then sure, try to maximize it. That's but only once you're in the box.
Yeah, no, that makes sense. And there's a question from our audience, from Raphael, who asks, how big is the problem are you solving, one, and then two, is it primarily based on overexposure on a single institution, I lack of diversification? And I'll take a stab at answering the second one first and ask you to comment on that, and then answer the first one too. How big is the problem? But diversification is important, but I love that you picked up on it's the collateralization, stupid. Again, anyone that's come from a capital markets world and then goes out into the rest of the world, I remember I was totally freaked out that there was all this unsecured lending going on, and deposits and is part of that, but even beyond that. Now there's a place for that, I must admit, but I was, after 15 years of like everything's collateralized and the only thing you're talking about is haircuts, right? You know, over collateralization, for those that the haircuts mean how much do you have to over collateralize to borrow 100? Do you need 110 of assets, for instance? You know, the other thing about diversification in the context of deposits that I think one of our old partners, a venture partner, Yan here, has been banging on about this a little bit on social media too, is that even if you because there's a lot of solutions that are about splitting your deposits across, you know, a number of banks to make sure you're never above the insurance threshold. And that is probably better than not doing that. But nonetheless, underneath you have a single, at least in the US banking system, you have a single insurer. And it reminded me of the old days when MBIA and AIG were insuring all the credit derivatives. And it's like, oh, no, it's okay, it's all good. We have a AAA insurance underlying it. And, you know, immediately the thought was, well, of course, the moment that anyone needs to make a claim on that insurance, it is no longer AAA. It probably, in that case, it went from AAA to default instantly because it was completely contagious. In deposits, it's probably maybe not that acute, but we're seeing now people starting to pay attention to the FDIC's capitalization and sort of doing the math. And, you know, it's like everything in fractional banking. Nothing is built to withstand, you know, instantaneous liquidity. And that's a feature and a bug. It's not just a bug, but this idea that diversification will save you, and it's the only thing you need to do, I think is not really the answer. It's a combination of these things. So I don't know if you have thoughts on that, and then how big is the market? And we'll finish on that maybe that Treasury Spring is addressing.
Yeah, I mean, look, I totally agree with you. Deposit insurance arbitrage is a thing. You can question like the morals of it, depending on who pays for the insurance. You know, in the UK, it's the FSCS, which is the Financial Services Compensation Scheme, which ultimately comes out of the taxpayer. Even in the US, when it's the FDIC, how does it get paid for? It gets paid by bank levies. Where does that cost end up? It ends up in the hands of the consumer. So I don't think it's in any of our interests to be encouraging people to just end up with deposit insurance, even if it's going to pay as the end game for all of this. In terms of how big is the problem, I mean, look, when we started talking to people in 2016, a lot of people didn't realize there was a problem. You know, they're like, we're in the most benign credit environment there's been for a really long time, and rates are kind of zero or negative. I think if you ask people today, most people who either had any nexus to SVB or to Credit Suisse would tell you that they're pretty sure that there was a problem. You know, they may have got their money back, but they had pretty uncomfortable weekends. And I think if you offered them the opportunity not to go through that again, they would take it. And I think you sort of started to see the ripple effects in the banking sector. You started to see the extent to which kind of the iPhone world, whether that be because we can all withdraw our money over 10 seconds, or whether that be because Twitter means that rumors go around like wildfire, just has exacerbated the problems of maturity transformation and fractional reserve banking. And so, yeah, for us, it's a multi-trillion-dollar problem. Whether people absolutely realize that they've got it or not is a little bit of a function of who sits on their board and the background of the people in the finance team. But yeah, I can tell you everybody who's ever worked in capital markets understands that it's a problem. And so I guess it's incumbent on us, not just because we're trying to build a big business, but also because we genuinely have a desire to build a better functioning short-term capital markets in order to encourage diversification, collateralization, risk reduction, and the removal of kind of big systemic hubs that can only be bailed out through insurance or other metrics.
Perfect. Well, thanks so much for your time, Kevin. I think, you know, my conclusion is that, you know, it's an interesting mix. Venture is the opportunistic, you know, greed extreme of, in the good sense of capital markets, and cash markets need to be, and haven't always been, at the resiliency end, right? And I think what you guys are building, and, you know, we're super happy and proud to be partners along this journey with you guys, but building that more resilient plumbing for the global cash management and treasury management frameworks is really important work. And I think, obviously we're talking our book, both of us here, but I think you can build a really big business if you get that right. So again, thanks so much for your time today. I know you've got in a good sense, the phones are ringing off the hook a little bit. So I know you've got to drop now, but for all of those listening, if you have further questions for us or for Kevin specifically, please let us know and we can follow up bilaterally later. And I hope we found that useful.
Thanks very much for having me, Sean. Great to chat to you as always. Speak to you soon. Cheers. Bye.
Thanks, Kevin. So now, everyone, I'm pleased to welcome Jess Holzbach, who is the founder, CEO of Pile, another Anthemis portfolio company, a little bit earlier stage, back through our Female Innovators Lab. And Jess, I think you might have been listening to the conversation with Kevin. If we can maybe start off, I'd love for you to share with the audience a little bit your origin story in the context of how you came to starting Pile and what you're working on, and what is the context behind that, and then we can dive into what you're doing, your thoughts on what can be improved in terms of treasury management for startups and SMEs.
Yes, thank you so much for having me. It was super interesting to also listen to the first half an hour, definitely coming from a bit of a different perspective. So my background is that Pile is actually my second company. So before that, I built Penta, which is a SME bank here in Germany, which was recently sold to Konto. And I basically built this up from scratch before it got sold. And already during that time, building a challenger bank for SMEs, we always saw that this is kind of the basic layer of banking we're building. It really kind of gives startups and like SMEs the basic operating account, but there was nothing in intelligence on top. And during the last, I would say, year that we started building Pile, we always had this topic of treasury in the back of our mind. We actually started in a bit of a different scheme. We wanted to build something for treasury management around crypto APIs, but realized that this is just something that didn't really find enough, I would say, demand in the market over the last, I would say, couple of months. So beginning of this year, we actually decided to kind of start, fresh, to really go out into the market, talk to customers, and try to understand what is some of the problems we could solve for them and what is some of the pain points they have. So in January, I think we ramped up a lot our customer discovery calls. So I think I was speaking to 5 startups a day for, I think, 4 weeks in a row. And what we learned during these calls is that, I think similar to what you said, everyone didn't think treasury management was that important in a sense that it was like on their board agenda or on their like real agenda, but they realized that there was something as positive interest rates, and they were letting like a little bit of money lying on the table. And I think they got curious once we kind of said there can be an easy solution how you can set this up. And we kind of dig deeper into the topic, trying to understand the pain points, and decided to go more into this direction. So since beginning of March, we launched our treasury solution for high growth startups. And I think to kind of wrap this up on the other side of the market, and micro VCs and business angels. So our vision is more to become the central place where venture capital holds their capital in a safe and secure way. From there on, they can manage, deploy, and use the capital. And I think we're learning a lot. We're still very, very early, but trying kind of to speed the development process up, because what happened with Silicon Valley Bank, Credit Suisse Bank, and a lot of things in the market right now just kind of showed us the importance of bringing out a good, easy, and transparent product to the market very fast, because I think all of the kind of startups, but also the VCs that I spoke to over the last couple of months kind of told me that most of them, I would say like 80 to 90%, did not have a treasury setup in place. And they're really trying to get something up and running now. But I think there's two things they're missing. There's a little bit of competence, like, so they really don't know exactly what to do. And the second part is they're a bit afraid of the effort and the hurdle and maybe some of the accounting mess that this would create.
Yeah, no, that makes perfect sense. And again, many in the audience, especially some of our LPs, will know that small business focused fintech, if you will, financial solutions has been an area of interest for us for some years, and one actually that for many years we were a little bit frustrated because we knew there was an opportunity, but there was a bunch of things that needed to be built, cultures needed to be changed for it to actually be addressed. And in the last 2 or 3 years, and we think going forward, certainly for the next 5 or 10 years, there's a massive opportunity there. And the very short version, simplistic, but I think robust version of our vision is that technology enables the translation of complex financial solutions to be able to be delivered efficiently, where everyone wins. The customer can afford it, the company providing it can make a margin on it, which historically wasn't the case. That was the big blocker. And I worked for many years in a corporate investment banking, and there was always, in the bank I worked for, it was a German bank, literally every year, I think there was only one time I was there, it lasted 2 years, the SME business would get flipped between the corporate bank and the retail bank because it didn't have a home. And the corporate bank didn't want it because the customers were too small. And it was like, they would make $100 of revenue for $1,000 of costs, or 100 euros of revenues for 1,000 euros of costs. And the retail bank wanted it because they liked the 100 revenue, but they didn't have the tools or the products to serve it. So I think, my understanding is, Pile is in that category of, okay, we can use technology to bring, maybe not in the first instance, Apple or British Petroleum level, BP level treasury sophistication to the 10-person startup, but there's a middle ground where the startup, the opportunity space is nobody in finance, or maybe a controller and an accountant. As you see, the skills not there, and then the systems, even if there were the skills, because there had to be someone at the random of the 10 employees happen to work in that space, who has the time and who can get a regular, sort of the regular providers of those treasury products to pay attention to them, even if they had the sense to call up and say, oh, I'd love to have, an account to trade treasury bills and an account to, with money market funds, and I want to split my banking balance and have a sweep account, all that good stuff, which in theory isn't rocket science per se, but the operational complexity of it is pretty intense. Is that the opportunity space that you see and are going into? And where do you think, if that's true, I see you nodding, so I think where do you start? Because I think that maybe in that context, the biggest risk for a company like Pile or to address this space is not boiling the ocean. What do you think the right entry point is, the low-hanging fruit, as they say, that you can build on in the quarters and years to come?
Yes, no, this, first of all, it hits the spot directly. So what we saw is we have two sides, right? We have the retail market that is, I think, already quite sophisticated. You have a lot of products that you can use. We have the corporates, or the bigger companies, we say from Series C onwards, that are also served already much better and have the competence in-house. And we focus exactly on this underserved group in the middle. So that's definitely correct. What we do, or what's our biggest hurdle now, is obviously to build a product and build this complexity very, very fast, but also very secure and reliable. So I think demand and kind of pull from the market is not a problem at the moment. We really haven't done anything on that side, and have a lot of customers basically coming in. So what we do is we actually start with the absolute basics. So we identified from the conversations with the customers, there's 2 things, or let's say 3 things they actually want. So the one you guys already discussed is actually the diversification of capital across different bank accounts. So that's a real thing for smaller companies, because if they only have, let's say, 2 to 10 million on the bank account, for them, it's actually quite interesting to have a banking stack that has, like an operating account, a revenue account, and maybe one account where they just put the money and they don't have to like think about it, and it's like safe and secured. So that's something that we're like setting up. So we kind of give them the opportunity to have a diversified portfolio of different banks. We do this by working together with different banks. So we have on the one hand, Challenger Bank, neobanks in the background. We have a base account ourselves in the background. And we have the big kind of too big to fail banks in the background as well. So people can, for the beginning, choose their own kind of banking stack. We also have the opportunity that people can come with their existing banking stack and just kind of upload or like integrate everything into our app. So you have like an overview of all your different accounts, because what we learned, and that's maybe the second pain point we're addressing, that a lot of companies manage their bank accounts with Excel sheets. So they know, oh, company one has account in Spain with that company two has that's the IBAN, and they have like sheets that are that long, especially if they're operating across multiple countries in Europe. So it's like, actually, it sounds like a no-brainer, but it's like an open banking aggregation of different banks and different accounts in one place that you can manage from there. And then, have easy overview of, for example, your monthly burn rate. And you don't have to go into each and every single bank account to kind of calculate this like in a single kind of way. And then the last point that we're addressing, so it's 3 pillars. It's this like banking stack, aggregation. And the last point is financial instruments. And there, I would say we're still at the very beginning and not as far as TreasurySpring in the level of advancement, but we offer different like fixed term products. We kind of want to make the connection to money markets and just give them different financial products to choose from that not we are like developing, but always our banking partners. So we are a bit like I would say, layer on top, kind of agnostic and objective, and want to just help them with kind of the advisory on how to set up their whole treasury function.
I was smiling when you were talking about Excel spreadsheets, because I have a little heuristic that, is, and this is a positive heuristic that sort of, if, and nobody ever pitches it this way, or certainly not anymore, maybe 15 years ago they did, but if the pitch is replace Excel, that's like 80% of all enterprise fintech solutions. And that's not a bad thing. That's a good thing, because replace Excel means that that's something that, despite having a not made for purpose tool that's a nightmare to manage with all its risks and blah, 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 they're still doing it because it's a job that has to absolutely be done. So we use that as a little bit of a fun, does this replace Excel? And actually, if the answer is no, which is rare, then okay, then there's actually a higher bar to meet. Like, why is this important to do it all? One of the questions I thought, well, I was talking about like our experience at Anthemis in terms of being interested in, or knowing that there's a solution space, a problem space with solutions to be had for many, many years, but not really seeing much emerging. Our hypothesis over time was that, there was a lot of infrastructure that needed to be built. So as an operator in this space now today, how important, or on any vector, speed to market, doability, like just feasibility, unit economics is the sort of, I'll use as a broad-based metaphor as opposed to specifically open banking infrastructure to enable people to build these kind of solutions, efficiently, with good unit economics and in a timely manner. Is that an important prerequisite for what you're trying to build today?
Yes, definitely. I feel so 2016, I built Penta, and we built then like a challenger bank, and it was already a revolution to enable digital onboarding for businesses. And I think if we wouldn't have these basics, so there's like banking as a service, right? So we chose banking as a service provider to be able to kind of launch our product within 2 weeks. So that's obviously like helps us with speed to market. Then the whole topic around open banking is basically the modern or easy way to aggregate most of the European banks into one single interface, and not only have like an overview, but also have like payment initiation, right? Or like execution of things. So a bit more intelligence in the setup. So I think what we are doing right now would have been very, very difficult a couple of years ago. And we're definitely building on top of the current stack of technology that's already out there.
That makes sense. Could you maybe share, and this is an answer, I'm paraphrasing it, one of the questions from the audience. Could you maybe talk about, since you're in the early stages of building this platform, and I know, or I assume or suspect that this is very likely to change as you get feedback from the market adaptively. But as you are today, what do you see your product roadmap in terms of the key products go to market? Knowing that the sort of how long is a piece of string in terms of what you could eventually build, firstly, and then secondly, and that might be related. What is your roadmap in terms of geographies? Especially, I know you're based in Europe. Europe has one of these weird. There's some things that are Europe-wide. There's a lot of things that are still national based, and then beyond Europe. How do you see those two? I guess probably interrelated but different roadmaps.
Yeah.
In the next 12 to 24 months, let's say.
Yeah, starting with the second. So I think it's already an achievement if you can build a financial solution that is European-wide from day one. So that's what we did now. So it doesn't depend where the company is registered. If it's a European country, we can onboard them. And I think that's already something that was not possible a couple of years ago. So I think already quite happy about this kind of starting point. I think Europe is a good market because it's very difficult and very different from the US. US is already quite advanced. People think a bit more about treasury. There's a lot of competition already. But here in Europe, there's almost nothing to date, especially for this target group that we have. So I think we will be quite happy with our space here. And in terms of roadmap, to be honest, we always had, or in the past, I always planned like very much ahead. Now we're rather kind of taking the feedback from the customers, and we focus a lot on the kind of target or niche group we have now. So our basic hypothesis is, or like the idea is to be this like central place for venture capital in Europe, which means it can be for startup, it can be for business angel, it can be for VCs, right? And from there on, kind of let them manage, safeguard, or like deploy their capital. It can mean a lot. And I think we're currently building ahead of like, or along this like vision. The next steps are pretty clear, but what happens after that is still depending a lot, I would say, on the customer feedback. So at the moment, it's really this easy account opening across multiple bank accounts, kind of KYC sharing. So it's kind of one-click account opening across multiple providers. It's the aggregation of the overview, and then it's adding all the kind of financial, obviously all the standard financial products in the background, a little bit like I would say, marketplace. So at the moment, it's mostly the banks that come to us and they want to kind of offer their products via our, I would say, go-to-market expertise, because that's what we are like good at. We're like good in kind of getting the customers on board, and we kind of want to leave the rest to the banking partners in the background. So we're a bit like this, I would say, financial curated marketplace, adding more products in the background, and then just helping, I would say, startups and VCs to be a bit more efficient, liquidity management, have like a bit more intelligence and oversight over what's coming over the next couple of months for them. So really like making their life and their, I would say, CFO treasury function as easy as possible.
And that makes a ton of sense. As a nice segue into one of the last questions I want to ask you is your thoughts on build versus partner in the context of being a platform, being an orchestrator. And we're involved in a number of companies that have this I think positive challenge where how do you think about that? What is something that needs to be, in your mind needs to be natively built into Pile, and what is something that would be better off partnering with one or multiple providers? And that could be, I think you touched on that with financial products. That seems an obvious place. You're not going to reinvent every single financial product. I think that's, but on the sort of product side, the intelligence on top of it, which you talked about earlier, that's probably a little bit more subtle. What's important for Pile to build in natively to the platform versus what you want to plug in. And if you have any I know it's super early days, but thoughts on at least how you're thinking about that. And, would that be are you thinking about that in terms of in context of like more of an open marketplace or more curated, or an API, I guess, because every company is built on APIs today. Just thoughts on that would be super interesting, I think, to our audience.
Yeah, I think we're not, or the vision is not that we're just this open marketplace, for example, like Raisin, where you log in and then you have to figure out yourself. It's much more curated and much more like subtle, I would say, in the background. So we, like I said, have partnerships with different banks. We get approached from banks and we kind of integrate them, but it has to kind of be in the whole look and feel of the Pile layer, let's call it like that. And what we're hearing also from the startups is that they need somebody to take them at their hand, right? They don't want to now in the app have 100 different financial products and then have to read through all of them and choose again. So they need a bit of like hand-holding and direction there and intelligence. And I think that's what will be our core and our core kind of function to help them kind of set this up. But yeah, I'm a bit, I think there's like a good partnership and there's like dependency. So you just have to kind of balance this out, right? So I think it always helps with speed to market. And in this current environment, we just have to be fast. And we have to also rely on people who build really good products. So we don't have to reinvent the wheel there. But obviously, if you go into some sort of like very high dependency and then you realize the customer experience is not as great and kind of integrated it that much into your kind of native setup that you can't go away from that, then it's a problem. So we're trying to keep that balance. But in the end, it's always about the customer experience and like what the customer wants and what's helpful for them.
And given that, I think we talked about this a little bit earlier, just before the call started, but the audience today is mainly your fellow Anthemis portfolio company, founders and executives, finance executives, and a large number of our investors and LPs. To that audience, are there any, as you lean into this newest version of Pile, are there any asks that could be relevant that you think that audience might be able to help you with in the weeks and months to come?
Yeah, I mean, I think what we're bringing, so with Penta, like I scaled the company up from 1 to 45,000 SMEs. I think what we're doing now is focus on the really kind of, I would say, like on the cream de la cream from this like startup world. So we really want to have like high value startups, high growth startups. We require like a minimum amount of funding. So the ones that have, like secured like assets and really want to like deploy that. So I think this side is what we bring into the equation. But anybody who kind of is interested in this customer group wants to kind of have like different, I would say like sales channels, wants to offer like their products to exactly this target group, like I'm super happy to have the conversations because that's exactly what we are like building at the moment.
I forgot to ask the question when we talked about Europe, because I'm getting too old. I still can't believe they did this, but does the UK count as part of Europe in terms of what you can offer, or is it continental Europe, EU? Just for a clarifying question.
Unfortunately, continental Europe.
Yeah, or maybe fortunately, who knows? But just I wanted to make that clear to the audience.
Yeah.
Great. So thanks so much, Jess. I think that's been super helpful. I think, as I mentioned at the top of the call to everyone, this is the first in a short series. I don't think we'll be doing 42 episodes of risk and treasury management. But this is a topic that has been dear to our hearts for a while. As you can see, we've made some investments in this space. There's actually a few other companies in the portfolio that are also active, maybe a little bit more relevantly, but a little bit more tangentially. And I think beyond the specific topic of liquidity, treasury, cash management, I think it speaks to one of the areas that we're have been and continue to be most excited about in finance is actually building a new modern financial infrastructure. It's not to say that a better direct-to-consumer focused insurance product or banking product or what have you, or business part can't be interesting, but there's a lot of people focusing on that, and certainly over the last few years. there's a lot of competition. I think from as a citizen of the world for our societies, that's a great thing to have more competition. But one of the things that we are, continuously hoping to encourage and are so happy when we find entrepreneurs like Jess and Kevin and others that are people working on, the guts of the system, so to speak, because that resilience and what technology can unlock in terms of democratization and resilience, we've always seen since we started Anthemis as being, one of the key North Stars, one of the key opportunities in this whole sort of post-global financial crisis, fintech revolution. So again, thanks to Jess, thanks to Kevin for joining us for this conversation. The next one, I don't know, Sophie, if we have the date for the next one. The next one will be with a friend of Anthemis, a Cornell law professor called Bob Hockett, who authored a book called Financing the Green New Deal. And he'll be talking about his views on universal deposit insurance, and how that's important, and how, from a policy point of view, regulatory and policy changes can go as a tailwind or accompany these business model and technological changes to building that more resilient and more democratized non-zero sum financial system. So for those of you that enjoyed this, hopefully you'll be able to join us for that next iteration of this series. And as always, we thank you for your time and support. And I hope you found those conversations useful. I certainly did. And again, thank you, Jess and Kevin. If you listen to the second half of this as a recording later, thank you, Kevin. Sophie, is there anything else that you'd like me to cover?
No, that's all. Thank you so much, Sean, and thank you everyone for joining, and look out for the next webinar coming soon. Bye.
Thank you.
Bye.
Bye.